Okay, I'll call today's April 30th meeting of the Finance Committee to order. Mr. Samario, what's on the agenda?
Yes, I'll introduce it initially. So we're here to talk about general fund revenues in a multi-year forecast in the context of our proposed fiscal year 2020 and 21 financial plan. As you know, we're really going to focus a lot on next year in general because that's the recommended budget. The second is more of a plan. So today's revenues, general fund, we're not talking about any of the other funds like enterprise funds and the like. The focus is general fund, where we have revenues that tend to be more volatile, revenues where we don't have the ability to control them as much. Tax revenues, we can't really control what they do. And historically, we've seen a lot of volatility in our revenues, particularly our tax revenues. So for us, it's really important for us to monitor them monthly. We do this all year long. This is something that Jennifer and her staff do year-round, monitoring all our key revenues to see how they're performing based on expectations and see what's going on in the economy, both local and state and so forth. But from a budgeting perspective, it's important because in the general fund, it sets the table for how much we have to spend. So they're really important numbers. And we try to be not too conservative, not too liberal, because either one of those can get us in trouble. We try to be really kind of moderate. We use the best data we have. There isn't always a lot of data for us to use in developing these projections, so some of it is just sort of general trends, and we look a lot on the last few years. But wanted to share with you kind of some more detail than you've probably seen in the past in terms of how we've come up with our projections for the next year, and let you sort of kick the tires a little bit, tell us where we might be too conservative, might be too aggressive. Ultimately, we would like you to make a recommendation on these revenues to the full council as to whether our assumptions are reasonable or not and whether you want to change those or not. So we are going to go into a little more detail than you have in the past. It's not exhaustive, but we're still going to be probably within a half an hour or 40 minutes. Once we go over that, I'll just show you a couple quick slides on a multi-year forecast, projecting out beyond the 2-year financial plan, another 2 years, what are the trends, and doing some what-if scenarios. So with that, I'll turn it over to Jennifer Tomaszewski. She is our Treasury Manager. She's been with the city about almost 5 years now, but our Treasury Manager for about a year or so. Is that right?
It's about 9 months.
9 months. Anyway.
Like 5 years.
Thank you.
I'm Jennifer Tomaszewski, and for my presentation today, I will start with a summary of the non-departmental revenues, and then I'll go into more detail in the individual revenues themselves. But this first slide is a little bit hard to see. I should have used different colors. I see that now. Apologize for that. This is a summary, sales tax, Measure C, property tax, and so on. And what we see here in fiscal year 18, we had about $92.7 million in tax revenues. And in the second section, the orange section, we see this is what's going on current year. We have our adopted budget of about $112.6 million compared to 116.2 for a variance of about 3.6. I'm going to go into these again in more detail, but the main takeaway with this slide is that we see the biggest variance is in that sales tax and Measure C, and that's because that recurring theme you've been hearing that we received some of that money that should have been received in 18 this year. So we'll look at that in more detail. But to put a little bit more context to what does that mean for the 20 and 21 budgets, in total, we see growth of about 2.9% for 2020 and about 3.3% for fiscal year 21. Next, I'm going to talk about sales tax. So sales tax is our second largest single source of revenue. Our sales tax rate in the city is 8.75%. So 1% of that comes back to the city. The rest, and then 1% also now comes back in Measure C money. The rest of that goes to the county and the state. So what we're looking at here is the 1%, the regular sales tax. We look at sales tax on a quarterly basis. We track it on a quarterly basis. We receive monthly payments from the state. They pay us every quarter. The first 2 months we get an advance, and then at the end of the quarter we get a true up. So really that true up's what's important. They those advances, sometimes they may be higher or lower, but it's that true up that really matters. So when we put together our 20 and our 21 budget, we had received 2 quarters worth of information or of sales tax. So you see in the white areas, those are actual numbers. The grayed out areas are forecasted or projected numbers. So looking at it this way, in fiscal year 18, we see that we had about, a little over $20 million. For fiscal year 19, we're projecting about 23.7, which is about 1.9 million higher than what we originally budgeted. And this slide is titled Unadjusted, and that's because it includes, it's when we received that cash. So that in that 1.9 million is buried about a little over $1 million that we should have received last year, which skews our growth to over 15%. So in the next slide, this adjusts for that. So this is really where we want to look at our talking points. So when we adjust out that prior year money, we see that about that 1.9 drops to about a little over $700,000 and about 4.7%. Now, when we look at that on a quarterly basis, just to put a little bit of context to this, and we will look at historical sales tax on the next slide, but when we put the budgets together, we use a growth rate of about 1.5%. That's what we've been using in the last few years, and then we go from there. So when we look at our first quarter this year, we see that came in a little bit higher at about 2%. In the second quarter, it's a lot higher and 13%, but that's also a little bit skewed because last year we had the impacts of the Thomas fire, so that changes those percentages. And then we recently just received a letter from the state, which they, in an error, they gave us about $200,000 more than they should have, which kind of feeds into my next point being, there's a lot of moving pieces with sales tax. And in the last year, we switched from the state the Board of Equalization used to be the agency that managed the sales tax program. That was changed to the California Department of Tax and Fee Administration. And with that, they implemented a new software. And ideally, when all the bugs are worked out of that software, it will be better information, but we're not there yet. And we're seeing a lot of errors. That part of why we received that $1 million so late is because they were working through those bugs and they weren't processing sales tax returns. Now they're processing them, but they're finding errors. We are also hearing that once all the bugs work out, they have potential to look for anomalies in sales tax returns. So hopefully they'll find issues and we'll get paid. Those will get corrected sooner. But we're seeing revenues now coming in higher than we had expected. I think every day it's highs and lows. Every month we get that check, and when it's higher, we hope we can trust it, but we're still waiting for the dust to settle with the state. So that's why we see a high number in the second quarter. For the third and fourth quarters, we're projecting that 1.5% growth. With the last quarter, there's a little adjustment built in for the new Target store. So that's a little bit higher. A lot of information, but the result is we're expecting it to be a little bit higher than our budget, even adjusting for that prior year revenue. Probably, depending on the corrections that they make, it may not be this high, but this is the best information we had at the time that we were preparing the budgets. So how does that translate into 20 and 21? Again, we start with that 1.5% growth, and then we adjust for the items that are coming down, that are coming that we don't see in the current numbers. So, for example, the effect of cannabis sales, that's going to add to our sales tax base. Online sales, the recent court decision with Wayfair, we think that could potentially be what we're already seeing in the second quarter. Amazon and Wayfair are already voluntarily starting to collect sales tax, but we anticipate that could go higher as well. And then also new retail. So that translates to about a 4.3% increase in 20 and 1.5% in 21. So next we'll look at what does that look like in a year-over-year trend. Did you have a question?
Yeah, so your subtotal for 2020 is 4.3% growth. So why is that so strongly deviating from the 1.5?
Because we start with that base growth and then we factor in new taxes that we haven't started receiving yet. So for online sales, cannabis sales, we anticipate that sales tax will go up for those purposes as well, but those aren't in our current numbers. Those are new revenues that will be coming in the future.
So the cannabis tax is rolled into these numbers?
Into that, yes. So we start with that 1.5%, and then we build from there. For those, we adjust. I shouldn't say we build, but we adjust for the items that we know that are coming.
And just to be clear, we're talking about the sales taxes on cannabis revenues. They're subject to sales taxes unless they have a medical card from the state, in addition to our excise tax. So there's two things going on. We're talking about the sales tax on cannabis sales, not the excise tax, which is something different. And then the reason it's 1.5 in 2021 is because once those new revenues come into play in 2020, that becomes our new base. And then we're just growing our typical growth from there of a 1.5%. At least that's what we're projecting.
So the actual change looks like you have forecast about $1 million. So to go to 22,589 to 23,576.
That's correct.
So the $1 million then would include the target, the cannabis sales tax, and the online.
Correct.
Okay, thank you.
So this next chart shows sales tax from 2012 to our current 2-year budget. And before 2015, we saw higher growth in sales tax. And then it tapered off in 16 and 17. 18, there's the impacts of both the Thomas Fire and the prior year, the payments that we received in 19. So 19 is a little bit higher. Again, when you adjust that down, that's closer to the 4%. And then that's kind of holding, it's more conservative from that point on. But just to put a little bit of context of what that looks like compared to historical numbers. So I also added Measure C in. So Measure C is new, and fiscal year 19 is the first year of a full year of Measure C. It follows similar to sales tax. There's there's some differences in district tax and sales tax, but for the most part, they're very close. We also had about $1 million, I think it's $1.2 million, we received in 19 that should have been in 18 as well. So again, just to put some context to what that growth looks like. Next, I will talk about property tax. So property tax is our single largest source of revenue, and it's also our highest growth for our revenue budgets. And so again, the county manages the property tax payments. So taxpayers pay the county, and then the county distributes that money to the different agencies, to the county, the special districts, the school districts, and the city gets a portion of that. And that percentage can change based on tax rate areas and property values, but so we get a portion of that. And I should say that most of the tables are going to look very similar, but we track them a little bit different. So sales tax, we track by quarter. Property tax, we have different categories of property tax, but when we're talking about property tax, we're really talking about that first line you see on this table. That's the majority of our property tax revenues. We also have airplane tax, interest, supplemental tax, and then the county collects an administration fee. And then we have our RDA property tax. The RDA property tax, that is the residual property tax from the dissolution of the RDA. The way that that's allocated is the properties within that previous RDA get that tax revenue, it's also, the county also manages that. They subtract out an administration fee and any bond debt. This last year, we've been paying bond debt of about $8 million a year. When we take the net of that, then the rest gets allocated to the different jurisdictions within that former RDA. That percentage, the city's percentage of that has fluctuated between 11.5% and 12.5%. We see in fiscal year 18, we have a little bit higher RDA. And let me just back up again. So our actual fiscal year 18 was about 34.9 million. There's about 1.5 million that was one-time monies, both in the property taxes and in that RDA. So that's going to skew some of those growth, some of the growth that you see here as well. But when we're looking at 19 compared to budget, we're projecting a little over 300,000 additional revenues. We project this based on schedules that the county gives us. So this is the majority of it you'll see just looking at adopted budget compared to the forecast. It's in that RDA amount. So most of that 300,000 resides there. And I did want to point out some of that one-time money also from fiscal year 18 revised this growth down. If we adjust for that one-time money, that growth is really about 5.4%. So when we look at what we're going to budget for 20 and 21, and again, on the next slide, we'll look at historical percentage growth. We've been budgeting about 5.5% is what we've been seeing. We feel that that's been pretty accurate to this point. We do have the impacts of Prop 8. So back in in 2008, when the recession hit, the county assessor reduced property values to adjust for market at the time, and then over time they're allowed to increase that back as property values align back up after the recession. But the assessor has the ability to do that all at once or do that incrementally. And what we've seen is that they've been doing that incrementally. So over time, I think they're about 60 to 70% back to where they were pre-recession. So for the next few years, we feel confident that we're going to see that continued 5.5% growth. So that's what we used as our base for 2020. And sure.
I'm not sure if this is the appropriate place, but I think this is the RDA, but I'm going to refer to our actual budget binder. I'll read it out because I don't know if we all have copies of it, but on C14, which is the summary schedules of appropriations by fund, there's a line item that says general fund, and it says that the fiscal year 18 was 3.4 million, and then the fiscal year 19 amended is 9.1 million. And then the proposed fiscal year 20 is 1.88 million. So it goes from 9 million to 1.8. I can show you this, but does that have to do with the RDA?
I think what are you looking at the successor agency budget?
Hold on one second.
So the 8 million is the bond payment. So this last year in 19 is the last year we're paying that bond. And then, so what happens in 2020 is the net amount of the tax increment received that would have gone to the RDA is increased by that 8 million, and then we get our proportionate share. So we get about another million of that. So we don't get all of it, but we get a portion of that. And that increases our share of the general fund share.
Okay, so that big decrease was no longer making those payments to the
Correct.
bond. Okay.
Correct.
Thank you.
Okay, let's see. Oh,
So Ms. Tomaszewski made the comment that the county provides us data. So when we developed the budget for the current year, we did that really we finalize the number in March about this time. We don't get the real data until October. So in October, we will know exactly what the assessments are, what the levy was. So we'll have a pretty good sense of where, like we know this year, based on that data we got in October from the county, where we're going to be, particularly with the property tax line. The ones that will vary are some of those other categories, and in particular, the supplemental taxes. You'll see that's the supplemental taxes that occur when between the levy and the collection is when they have the whether because of property changed hands through a sale or improvements to a property where there's supplemental assessments. We can't predict those, and we essentially just assume we're going to get the same amount we got in the prior year, but we'll know that by June in terms of what the real numbers are. But for the property tax number, we now know what that number is. That's why we feel pretty confident in our projections.
So at what point, if ever, do you take into account the fact that we're in a historically long recovery from a recession and that our property values are starting to get close to, I guess, was it 2006 when it peaked? Do you just ignore those, and as long as we're going up, we're going to use 5.5 or?
Yeah, you want to? It's up to you.
I'll take the first stab at it. So some of that growth is just, there's also property sales that occur within the year, and so as properties sell, that base increases as well. So it's a combination of that, as well as the adjusting back up for those previously the Prop 8 decrease to those properties, bringing them back up to their pre-recession values. We always have to, we do try to look forward, but it's really hard to project what, it's really hard to know what the market's going to do. It's the same thing with our investments. We use the best information that we have, but we don't really know what's going to happen, to the real estate market in the next couple years. But we try to factor in everything and try to be very conservative with that growth. We based on the historic percentages, we probably could have gone up to 6%, but we try to be a little bit more conservative with looking at, what's a realistic number that we think could, end up happening.
So there's a lag between when property values flatten out and when the property tax increases start to flatten out. It just takes a while because of what you talked about, the constant reassessment of properties under
Right.
Prop 13.
And so even if the market, goes down, those property values are those, and until they sell a property, it's pretty much locked in at its base. Those aren't going to change a lot with the fluctuations in the market. What really triggers it is a property sale.
And in broad terms, it's probably fair to say that today, the market value of homes far exceeds the overall Prop 13 assessed value that they use for purposes of assessing every year. So as long as CPI can support it, they're going to increase that assessed value 2% every year until we have another real estate driven recession or values really stop growing for a long time, and where Prop 13 assessed values catch up to that. But short of a recession that's real estate based, we're going to be looking at least 2% unless CPI is below that, because they're limited to the lower of the two. And then it's just a matter of how much property recapture we're going to see, and then how much turnover in property. If the market's stale and there's no turnover, we're going to likely see less growth in sort of assessed value through reassessments. But that's kind of the 2% base is really kind of there no matter what, unless something dramatic happens.
So if I understand correctly, even if we're not seeing growth, there's a level of stability, because is that kind of what you're saying? If there's not turnover, then we do kind of understand what we're going to be getting.
Yeah, at a minimum, if we see nothing else, and if CPI is in the 2% range, we're going to see a 2% increase to assessed values, and therefore a 2% increase to property values. So that's kind of your floor. And then again, the other variables are turnover in property, general rise or values in property and real estate, and then the Prop 8 recapture is going to eventually run out in a few years. So it'll be really those other factors.
And again, the 5% growth in 2021. This next slide might help put a little bit of context to that. So you can see Here's our, and when we're talking about property tax, we're talking about on that last table, that first line, that's just the property tax. We don't have the RDA money and all the other categories on this chart. This is just the property tax. So we see that, up until 2016, growth, the average growth from fiscal year 12 to 16 was about, on average, about 3.9%. I think 12 kind of skews it down a little bit. But then you look at 17 and 18, and, we were seeing higher growth. Some of that growth in 18 is because of those one-time payments we received. There was a sale of property in the RDA, which impacted, I think there was about $700,000 extra that we got for that. And there was some settlements on some delinquencies that were received from several years back that the county finally distributed as well. So that skews it up a little bit. And then, so we see that trajectory is pretty stable. So, okay. Do you have any other questions on property tax before I move on? Okay. So the next category is our transient occupancy tax, which we call TOT, or our bed tax. For the city of Santa Barbara, our TOT is 12%. 10% of that goes to the general fund, and 2% of that goes to creeks. That's our Measure B revenues. And we track these monthly. Hotels are required to report their gross receipts at the end. They have by the 10th of the following month to provide their reports to the city, as well as the payments for their remittance. And when we prepared the 20 and the 2-year budget, we had actual information through January. And in 18, we had about $18.9 million. So there was a little bit a dip there, again, because of the Thomas Fire, and I'll loop back to that. This year, we're looking at about a $200,000 deficit from our budget. We forecasted when we built the budget, we assumed about a 3% growth, and we're still seeing growth of we're estimating about 2.8%, but it's just not as high as we had originally budgeted. So it's close. I mean, it's less than I think it's like 0.2%, it's 0.2% different. So, we're close. But I did want to point out, when we look at December and January last year, so December is where we had the fire, so there was about a 28% drop. And then in January, when the mudslides occurred and people were evacuated, we had a lot of the hotels were full, or at least there was a higher occupancy rate. And so that skews our percentages this year. So this year we see the opposite. December's higher compared to last year, and January's a little bit lower. So again, the main takeaway here is that we're tracking pretty flat, slightly below what we had originally anticipated, but we're still seeing some growth. So again, for our 20 and 21, we're sticking with the 3% growth. What does that look like in a year-over-year comparison? Up until 2015, we were seeing a lot of growth. And then that kind of tapered off in about 16 and 17. 17, we had the reduction of our vacation rental enforcement. So there was an impact of that. And then in 18, we see the Thomas Fire. So there's a negative growth there. And then the green lines being our forecasted. So, it's a moderate, we're hoping that it comes in with 3%. We've also factored in some of the new hotels. There was some construction last year for some of the, one of the larger hotels. We factored in, with the higher occupancy rate, percentage increase for that. So we did factor those into our assumptions as well.
Thank you. Yeah, I think you just spoke to this a little bit. I am concerned, given that this is so flat, that 3% may be a stretch. Do you guys feel that that's sufficiently conservative? I'm just wondering.
This is another one that's a little bit hard to predict. We work with Visit Santa Barbara. You know, we have more flights coming in, which bring more people, which, you know, potentially, you know, can draw more tourism to increase TOT. And it's not necessarily flat. It's flat compared to budget. Well, I shouldn't say compared to budget. We budgeted 3%, but we're really seeing close to that at 2.8%. So, you know, with, you know, the increased occupancy and, you know, you have to be a little optimistic. You know, I think it's within a reasonable range. I don't feel that it's outside of a reasonable range. So next is our utility user tax. So utility user tax, we have a 6% UUT, and on telecom, that's about 5.75%. We receive those monthly, and we have several categories of utility users taxes that we track. We have cellular, we have voice over internet protocol, or VoIP. I never like saying that word. It just doesn't sound right. I don't know. Telephone and prepaid, which combined make up our telephone source UUT. We've actually seen negative growth in some of these areas. Cellular, we're not seeing less users, but with competition on providers, revenues are dropping. Providers are dropping their rates. A couple years ago, we were seeing prepaid was, you know, going up as cellular was going down, but with those rates dropping, we're seeing less demand for prepaid. And with the same thing with telephone, with the landlines, more people don't have landlines. So we're seeing negative growth there. We assume negative growth in our 19 budget. In total, we're estimating that we'll be about 100,000 below budget by year end. If you look at 18, 19, and 20 and 21, there's not a lot of change there. There's not a lot of variance. Cable is another one that we're seeing, you know, a decline. More people are going away from traditional cable to Netflix and other, you know, streaming services like that. We don't tax currently on Netflix. It's in the legislature. They're looking at that, but we're not collecting currently. Okay, clarify.
So when back in 2006, we went to the voters to have them validate our utility users tax. There was some legal challenges across the state on the validity of utility users tax. And so we went to the voters to confirm it, to avoid a lawsuit, and they supported it. It was a general tax. One of the things we did was to reduce the telecommunications piece to 5 3/4 for induce sort of support. But what we also did at that time was we modernized our ordinance, because there was, back in 2005 and 6, we were seeing so many changes to technology and how some of these services were being provided. Electric companies providing phone, cable providing phone, you know, all those things were just changing. So we modernized it to make it technologically neutral, which meant that no matter how you provide video services, whether it's through coax or broadband, you're still subject to our utility users tax. No matter how you provide telephone, doesn't matter. It's telephone is telephone. So our ordinance in all those cities who modernized their ordinance like we did back then is applicable to video provided by the Netflix, Sling TV, Hulu, and all those sort of live streaming, you know, protocols. The industry has not agreed with that, and so there's a working group statewide working with our consultants. I'm part of that. We started that a couple years ago to try to convince the industry that yes, this is the right thing. You should be paying this, and they argued that some of the stuff is confusing. And then there was a piece of legislation that was proposed by I think a senator. Don't remember his name, Ridley, and it would have made the imposition of utility users taxes on those kinds of services, you know, prohibited that taxation. So we sort of backed up a little bit. That legislation never went through, never, you know, got really moved forward, and so we're kind of back to what should we do. A finance director in Pasadena didn't help our cause. They issued an administrative ruling to all these companies saying you are subject to our ordinance, and it got to hit the papers, the Netflix tax kind of a thing. So it kind of did a disservice to our efforts to work with industry cooperatively. We just met with our consultant. We're going to, get back at trying to work with them just to at least incrementally get them to say yes to some real easy things, like things that are more like TV programming that's really similar to what you would get through a cable TV service. But just get them to agree some basic things, but we're going to start that up. But it is subject to our ordinance. We have no doubt about that. It's just how we move forward with that without running into problems, and it's a little political. It's kind of a marketing thing as well. Anyway, that's where we're at with the UT on video. That's why we're saying that the video numbers drop on cable TV. It should be offset theoretically by what's happening on broadband, but we're not taxing that now.
So just to continue on, after cable, electric is one of our larger revenue streams with UUT. It's been flat. The last few years, it's been somewhat flat. There has been talk that the providers are looking at raising their rates with the recent infrastructure needs to kind of beef up their infrastructure, and, not sure how that's going to factor in with litigation. But there is talk that electric rates could go up. So if those go up, then we would see impacts to the revenues as well. We're holding our budgets fairly flat on electric. Gas is a little bit higher, but again, there's not a lot of fluctuation with these. Refuse is probably our largest growth category of growth. Rates have been recently increased for refuse, so that translates to higher UUT for refuse as well. Water's been a little bit flat this year. With more rains, there's less water need, which results in, the water sales impact the UUT as well. So just looking forward next year for cellular, for the next 2 years, we're expecting that negative growth will continue. So 10% negative growth for both years. And then on the opposite end of the spectrum, refuse up about 11% and then 5% the second year. I put a little bit different slides in here. I took a 4-year trend of kind of how they track each year. I think it's kind of interesting to see that in total there's not a lot of change, but when you look at them individually, they all track very differently. So this is, you can see this year's pretty flat compared to the last 3 years. But then when we start looking at these separately, we see electricity's higher in the first half of the year and lower in the second half. Gas is just the opposite. It's lower in the first half and then higher in the second half. And not a lot of fluctuation from year to year. Refuse, same thing, but with refuse, the rates are higher. So we see that blue line is 19, and it's a little bit higher than the prior 3 years. Whereas water, it's higher at the beginning and the end of the year when the summer months, and then there's a kind of a dip in the middle of the year. Then we have cellular and prepaid, and they're just all over the place, so they're really hard to predict. And then we have cable. Again, we see cable's lower than, where we were at fiscal year 16 was the highest, and it's been dropping ever since then. And then I will say voice over internet protocol is higher than the last 3 years, but it's on a much smaller scale, so it's not a lot of money. And so I just thought those were interesting to kind of see the different patterns that we track. And so there's a few other revenues. I'm not going to spend a whole lot of time on these. Franchise fees, they're fairly flat as well. You see there's not a lot of growth, and they're staying about 3.6%. We have, I've lost track of all my slides. So we have electric, it's very similar to UUT. So similar, the UUT is the end user paying the utility user tax. The franchise fee, it's the hauler, or not it's the provider paying for the access to the right-of-way, the public right-of-way. So I'm not going to spend a whole lot of time on that. There is one slide just to put just to show you the trends. But business licenses, I have a couple slides as well that we'll look at. But the same story, you know, there's not a lot of change there. Our business license fee, our annual fee is $25. That hasn't changed in a long time. And we'll look at that in an upcoming slide. Cannabis, this is a new one. So for 18 and 19, that's medical marijuana. That we're seeing the excise tax on that. For 20 and 21, that's been really hard to estimate. You know, the state expected that those revenues were going to be really strong, and now they're looking at, you know, they're saying, well, maybe 40% of their original, you know, what they originally estimated. We took those the three permitted retailers and what they reported as their estimated revenues, and we cut that in half and calculated the tax based on that, and I think we've even reduced it from that. So right now it's just, you know, we don't really know how that's going to pan out. And then property transfer tax, that can fluctuate from year to year. If you have one large property sale, that can really skew that. So we keep that at about a 3% growth for 20 and 21. But that's hard to predict as well. So just looking at franchise fees, really the main takeaway on this is that it's very flat. There was a blip in 16 and 17 with some late payments for electricity that should have been received in 16. But other than that, there's not a lot of fluctuation there. And then this one, I just thought this one was interesting. We have the orange line at the bottom is new licenses from 2006 to current, and they don't change a whole lot. They're kind of, you know, hovering at about 2,000 a year, whereas the blue line are renewals. So over time, they're tracking a little bit higher, but again, not a lot of fluctuation there. So that revenue doesn't change a whole lot. And again, here's the bar chart to show that. So I kind of already hit on these with the property transfer tax and the cannabis tax, so I don't really need to go through those again.
Can I ask a question about the cannabis? Did the $72,000 figure, did that include the application fees, or is that all excise revenue?
That did not include the application fees. I think we received those actually in 18, and it was a little over $100,000. This is strictly the excise tax on the medical marijuana dispensaries that are currently operating.
And is it fairly even between the two dispensaries that are open? Are we looking at $35,000 each, or?
That is a good question. I can find out and follow up with you on that.
It's pretty close. There's maybe it's a 60-40 split.
30,000, 40,000. And is our guess that the recreational or adult use will be higher because they don't have the same limitations?
Yes.
Because that's a pretty big increase. So that's a $430,000 increase. So
And so to be clear, that on the recreational side, we're looking to permit 3 retail dispensaries, but we also have manufacturers that are going to be that have been permitted with a total of 9 different businesses or permits. 3 dispensaries in manufacturing, retail by delivery, and so forth. So there are really 9 businesses versus the 2 that we have today.
okay, great, thank you.
And this last slide is actually the first slide we saw. I just put it back in there to kind of recap. So again, we're looking at about 3.6 million higher than our original budget for the end of this year, and then moderate growth of about 2.9% to 3.3% for the next 2 years.
And so I'm going to go through the multi-year forecast pretty quickly, and then, oh, sure.
It's unrelated to these, but I just wanted to ask the question. I think now is probably the appropriate time. For reference, it's page C7 of our binder, but it has to do with parking citations. The revenue is projected at $2.4 million. So my question is, and if you don't have an answer right now because it's too early, but you might know where I'm going on this, is with the recent court case about chalking tires, do we expect a decrease in revenue from parking citations?
So, Mr. Chair, Committee Member Friedman spoke to our attorney about that decision, and according to him, that decision doesn't apply to our state, California, but I think we are going to be looking at new technology anyway, where we're taking video or pictures of vehicles. We tried before with the license plates and the reader, then that when you circle back, it would automatically identify a license that was there again. But it didn't work because it was slow to pick that up, and they were kind of beyond that point when it finally registered. But we're going to be looking at other technology anyway. But at this point, according to our city attorney, it doesn't immediately impact us. So we're not going to expect to see any reduction because of that.
Thank you.
And that would be a departmental revenue source as well.
Yes.
And is that something, the departmental revenue sources, I know on our calendar, we're looking at fee changes on May 7th. So are things like parking tickets, will those be seen on that date?
They will.
Okay.
They will. We cover them here. I'm not sure we did cover them here, but
No.
we didn't. So yeah, it'll be brought forward because they are proposing some increases to those citations.
And that is a fascinating decision. I'm glad you brought that up. As someone who teaches criminal procedure in the Fourth Amendment, I think it is distinguishable because our city code does basically tells the public for the privilege of parking on our streets, you consent to this type of search, which is just the chalk. The other jurisdiction, which was out of our state, they don't have that written into their code. So this is something how we're legally distinct. So it'll be interesting to see if that would hold up in court under a further study, but it seems like it would.
So we'll come back to just wrap up and ask you for any kind of direction or thoughts, but I wanted to go through a multi-year forecast pretty quickly. So this is going to go out through fiscal year 2023. Our 2-year plan goes through 21, so just adding 2 years. And at some point you will see the enterprise funds like water, wastewater bring you, sometimes a 10-year multi-year forecast. Because they're rate driven and they can kind of, control those to a large extent. They have the ability to look out 10 years, and they do that for capital purposes. How much are we going to need to finance or pay for capital? We don't have the luxury, so going out really to 2023 is about as far as we can. That's really meaningful. But I just wanted to point out a couple things. So 2020 and 21, we're balanced. So obviously we submitted a balanced budget for the next 2 years, or plan. And just to remind you that we were able to accomplish that in large part because of some new revenues that we are budgeting. The $1 million additional property taxes we're going to be getting from the successor agency / RDA. Those are all currently we're going to pay for bonds, $8 million of bonds that we had outstanding from the old RDA. That's gone away, so that money will be redistributed. We initially estimated about $1 million. We've been in talks with the county. It's going to be closer to $950,000, but it's in the same ballpark. And then the cannabis revenues of $500,000 next year, conservatively, hope we get something close to that, and $800,000 in 2021. But that really helped us balance the budget. In terms of kind of looking out, we are, in my multi-year forecast at least, I'm assuming similar growth in the key revenues. So I'm assuming 5.5% for property taxes, 1.5% for sales taxes, and about 3% for bed tax. And what I've also assumed, and you won't see the details in this because it's just going to be a kind of a line chart. I didn't want to bog you down with a lot of the details in the forecast, but in this coming year, 2020, we've assumed what's called an anticipated year-end variance number of about $3.3 million. That represents what we expect to see in salary and benefit savings through vacancies and turnover and all that. Over the last few years, that number has been extremely high relative to prior years. We've seen a lot of vacancies, such as in police, library, parks and recreation, community development, just not just one, but multiple departments that have had extensive vacancies. And so where we typically may expect $2 to $2.5 million of savings, we've been seeing $4 to $5 million in savings that have really helped us because in some cases it's offset some revenue losses. So we felt pretty comfortable with projecting next year, and I think actually the next 2 years we budgeted $3.3 million. But in my forecast, going beyond that, I've only assumed $2.2 million because that's been our historical normal. I expect that we're going to fill up those positions. In fact, we've made a lot of progress in those departments, or a lot of departments in doing so. So just being more conservative. And then the forecast assumes, like we've had in the last couple of years, that salaries will go up by 1% per year. the total compensation costs or total costs will go up more than that because of the retirement component and all that. But the salary piece, we're assuming 1%. So this is what it looks like under this sort of status quo environment, that by 2023, we would have about a $2.5 million gap. Not a big number, because you remember the pension costs are going up, are factored into this. So it's within reach, but it's still not a balanced budget. If you go beyond, we're obviously the first 2 years, 20 and 21 are balanced, but then you can see the lines separate. Once, we go away from these new revenues and we start relying on revenue growth to cover our increasing costs. Again, as Paul has said in the past, and I've said in the past, the pensions is really the driver of a lot of this, because we're seeing it go up about $2.5 million per year, $2 to $2.5 million per year. So we're relying on revenue growth just to cover that, so that number before we even talk about salary increases and the like. But I just wanted to show you one thing, because without going into the details, I just wanted to give you a sense of how reliant we are on that revenue growth there, even at the nominal levels we're seeing. How we are very reliant on the continued growth. So I wanted to just show you what would happen if we had what I would consider a mild recession in 2021, so the second year of the 2-year financial plan, and it would be only a 1-year event, which is pretty unusual, but a 1-year event where our sales taxes, instead of growing 1.5%, they decline by 2%. The recession we had in 2001 and 2 declined by about 4%. When we had the Great Recession in 2008, sales taxes declined by about 16% over a 2-year period. Just to give you sort of some sense of magnitude. I've also assumed that TOT declines 2% versus growing at 3%. I think, again, very moderate. TOT decline in 1 year, something like 9% in 2008. So again, a very mild, short-lived recession. And then I also assumed in this forecast that once we got beyond 21 and 22 and 23, that we got back to normal growth. So we got back to 1.5% and then 3%. And I didn't even assume anything on property taxes, that it would be impacted. Is that realistic? I don't know. In 2008, that would be unrealistic. But in 2001, it was the dot-com bubble that burst. Property tax revenues didn't even blink. They stayed at 7% every year. And it was like almost we didn't have a recession from a real estate perspective. So I'm assuming in this scenario that our property taxes will continue to grow around 5%. And then other revenues that may be tied to the economy are also going to, in this scenario, are unaffected. So, even though we know the economy can affect building permits, planning fees, and the like, I'm assuming no impact to those, just sales tax and TOT. And just based on that, you can see that our gap almost doubles by 2023. It's a one-time drop, and everything continues to grow beyond normal, normally beyond that. But just that 1-year impact permanently lowers the bar. And that's what would happen in 2008, where we saw the dramatic decline. We've never recovered from that because that bar becomes so much lower, and you really don't recover unless you have a 20% growth the following year. You're always going to be below where you would have been had that recession that occurred or that dramatically. So the point here is that we are susceptible to even a mild recession in terms of our long-term planning and being able to pay for our pension costs going up. The pension costs, it's interesting because it's sort of a little bit of a curve up in that the increase is increasing, because as these discount rate moves are phased in, the third phase of that is more dramatic. So it goes from 7.5% to 7.37 to 7.25, and then it drops all the way to 7% in year 3, each of those being phased in 5 years. So we're going to see the impact sort of rise over time. And then actual cannabis tax revenues could vary substantially from our estimates, up or down. I'm not as confident in year 1. I think that we're probably being a little aggressive in year 1, but don't know. We have yet to see a business open up. We expect to see 1 or 2 open up in the next couple months. But there's a phase into that, and then we have the other ones that are probably going to generate more revenues, like manufacturing, that are not yet up and running, and will likely be sometime during the next fiscal year. So our ability to achieve $500,000 to me is hopeful, but it's not. We're not budgeting $2 million, so it's not our vulnerability is not that great, or exposure is not that great. But we can also do better than 800,000 in year 2. I just don't know. It's just one of those uncertainties. We have no data to give us to help us and decide what do we think, other than what they told us. We cut it in half, and then we cut it in half again. in terms of how we came up with those numbers.
So the two forecasts you give us, this is assuming the 2.2 million in salary savings.
Yes, in 22 and 23.
So can you tell us historically back with the previous dip, none of us were on council then, what did the city do in terms of salary savings and freezing positions?
That's a good question. We did a lot of, so we eliminated about 80 positions in that time frame over a kind of a 2-year period. We didn't lay anybody off, but we eliminated positions. We used some reserves, some of our contingency reserves to kind of help minimize the impacts. And so I don't remember, we didn't even do a hiring chill. We did a hiring freeze. But I don't remember the magnitude of all those. That was 10 years ago. So
Didn't we also, I believe we also had a furlough? Was there a
yeah, we
furlough?
did concessions. That was part of the strategy. We had essentially a 5% cut in salaries through mandatory furloughs. I just don't remember the magnitude of all of those components. But we had about a $10
Larger
million.
than this,
Oh yeah, we had about a $10 million number not to solve in 1 year,
right?
and then the following year another 6. So it was a big number.
Thank you. I really appreciate you pointing out the impacts, potential impacts of a recession. I know we've had this conversation. It's something that I'm quite nervous about, to be perfectly honest with you. And I also understand the tension here. We want to provide services and we want to be responsive to the fact that things are going well as plan for a potential rainy day. If we were to have a recession, say next year or the year after, do we have a plan in place to adjust the budget in the event that things go wrong in the economy? Or do we just, what I'd like to avoid is a fire drill. And so I'm just curious from a planning perspective how we would approach that.
Yeah, we have some lessons to draw upon. So we've been through this before. So one of the things we're going to look for initially is so first, what's the magnitude of it? Is it a $2 million problem versus a $10 million problem? That's a big sort of different exercise. To some extent, a $10 million problem, like we had before, is a little bit of a fire drill, but we still managed to implement a good plan and execute a good plan, and I think we got through that really, really well. So we'll look to our reserves, the contingency reserves. That's what they're there for economic downturns and the like. And so we would use those reserves sparingly in order to minimize the impacts to the organization, to the community in terms of services. We don't want to have to lay off people. So through attrition and the like, we can do that. And then over time, we would be looking to reduce our organization to the extent needed or raise new revenues if possible. Typically, it's risk cuts. But doing that really incrementally, again, using the combination of reserves and the like. So that's typically what we do. If it's a $2 million problem, that's what we'd look at. We'd implement a hiring freeze, those kinds of things in order to make that happen. And Paul sounds like he wants to jump in as well.
It's a great question. Thank you. One of the things we can do quickly, and we can do at any time in the budget cycle or in the fiscal year, is start holding positions open. And there's just, you say it, you tell departments, it happens. 3 to 5% of the organization turns over every year. And so once you see a recession kind of come, if it comes quick, you can put a hiring freeze on, hold those positions open, and that year-end variance will then grow and be larger than what we budgeted. And so that's how you can kind of course correct in the middle of a fiscal year and then set yourself up for the next fiscal year to have that discussion. So between that and prudent use of reserves, that's usually how we can manage something mid-cycle.
Just a couple of comments. One, it's more of a question about the 1% salary increases that we're forecasting. At some point, we're going to have to deal with the market. Are we keeping up with the market and the like? But in reality, if we stick, at least my opinion, and based on the magnitude of numbers that I'm seeing, that if we stick to 1% salary increase and we don't have a recession, which is a big, and if frogs had wings, we would likely be able to manage with minimal reductions to the budget over the next 3 or 4 years. The recession is really the wild card when it comes to how big is it and the like, in my opinion. I think absent a recession, even with the pension cost increases, I think we'll be able to sort of work our way through that with maybe some reductions in services and positions, but nothing dramatic. So that ends our presentation. I'd be happy to answer questions and then ask you for, for direction on what we've presented, particularly in the revenue scenario.
So it's, I guess, less of a question or just presenting a concerns. All of the numbers do seem positive. The property tax, the 5.5 plus with the RDA, it's up to an 8.2% increase. So it seems higher than it really is in terms of looking at that figure. TOT is positive. It's only 3%. My only concern there is with the Miramar and the, what's the other one that went back online after the floods in Montecito? Biltmore and San Isidro. So I worry that maybe that slows down the cities because those add, but then again, maybe their marketing efforts brings more people to the city. So I just worry that we have a lot of pretty big numbers up here, and we are at a position where we've been in a long economic expansion. So I just wonder, I'm trying to be optimistic. We had a boom first quarter in the U.S., 3.2% GDP growth. So that was amazing. So I hate to be a bear in a bull's run, but I just want to make sure we're not being too optimistic. But it sounds like you've done all the research and broken these things down in their components. So,
yeah, and we don't really forecast for a recession, because we don't. That's being too conservative because we'd be looking to make cuts to the organization on the expectation of recession, and we don't know when that's going to come. I thought it would come sooner than now. If I were to look at our assumptions, I think they're all really appropriate. Maybe we're being a little aggressive on the TOT. That if I was going to pick one, but maybe it should be 2% instead of 1%. But I think it does. And Ms. Tomaszewski said we're still in a reasonable band. I think we're only going to see increases from prices, not from occupancy. And typically you see a 2, maybe 3% increase in that regard. But that's the only one where I feel we're being a little aggressive. But the rest, 1.5 in sales tax as our base, and 5.5 for property taxes. I think those are very reasonable. And then essentially 1% growth on the other taxes like UT and franchise fees that's what we've been seeing.
any other questions? There's no public comment, so we'll open and close public comment. And so you don't need a recommendation at this point?
Other than if you feel like, at some point we'll be asking you for a recommendation. When we finish up this process in a few weeks, we'll be asking you for the kind of a overall recommendation of the areas we'd like to see changed or different. Then we would certainly want to hear that.
Okay, great. So we'll see you on May 9th, and this meeting's adjourned.
Yes, thank you.
Thank you.